In this video, I'm going to be going over 3 important things you should know about the ETF JEPI. And JEPI has become a very popular ETF among dividend investors over the past few years, so I definitely do think it's important for new investors or investors that have already invested a bit of money into it to understand important key factors because it is a little bit of a complicated ETF. And I do own this ETF myself. I do own a bit over $11,000 worth. So I am an investor myself, and I do have a bit of skin in the game. And before we begin on these 3 important things, if you do appreciate this content, definitely leave the video a like and subscribe for future content. So JEPI is the JP Morgan Equity Premium Income ETF. And the most important thing, the number 1 thing on this list at least to consider about JEPI is that it is not a dividend ETF, although it is very popular among dividend investors. This fund gets most of its income that the investor receives from options premium through something called exchange-linked notes, and only receives about 1 to 2% of its income through conventional means like dividends. So the way this fund operates, again, is through exchange-linked notes, and that is basically a type of debt obligation. So in higher volatility environments, an investor will expect to receive more income from this ETF. Kind of diving in a little bit further, the fund attempts to invest in US large cap stocks and delivers a monthly income stream from associated option premiums and stock dividends. And like I just showed you, the majority of that money is coming from those option premiums through exchange-linked notes and not conventional dividend investments. So what does that really mean? That means that you're going to have an income ETF that doesn't really operate as a dividend ETF. So if we scroll down from the NASDAQ page about its dividend, you're going to see a highly volatile dividend. So you're going to see this dividend in the cash amount column really jump around quite a bit. And depending on the month, you are going to receive either a large dividend or a somewhat smaller dividend based on the volatility in the market. Again, because how these exchange-linked notes work are essentially like covered calls. And if you know about covered calls, basically, when volatility in the market expands, option premium expands too. So if it is a volatile environment, you're going to get a larger income payment. Now, to compare with a more conventional dividend ETF, I am going to show you the dividend history of SCHD, a very popular dividend ETF among dividend investors. And you'll see a more so consistent dividend payment. Of course, every single quarter is different, but you do see, for example, in December, it did pay an increasing dividend. So you are going to have a lot more volatility with an option income ETF like JEPI, more so than a conventional dividend ETF like SCHD because of that volatility option factor. Now we move on to the important thing number 2. So this ETF seeks to deliver a significant portion of the returns associated with the S&P 500 index with less volatility in addition to monthly income. Now, although this does try to track the S&P 500, or at least the returns of it, it does not hold the constituents of the S&P 500 in full replication. If you look at the top 10 holdings, you see a list of stocks that do not look like the top 10 holdings of the S&P 500 at all, although there are some stocks like Microsoft and Meta that you do see in that top 10 of the S&P 500. The weightings are a lot smaller, and the weightings of this ETF are very narrowed with little divergence between the top 10 in weighting. So what I did was I brought up the top 10 holdings of SPY, which is a ETF that tracks the S&P 500 with full replication pretty much. And if you look at these top 10 holdings here, you are going to see quite a bit of difference. Again, you do see some crossover, like both ETFs had Microsoft in the top 10, but the weighting is completely different. And a lot of these stocks aren't even in the top 10 of JEPI. If you see here, there is many stocks that aren't in the top 10 of SPY. So you could say that this is quite a bit different holdings for an ETF that does intend to track the S&P 500. Of course, based on its investment methodology, it tries to choose stocks that have a lower volatility in proportion with other stocks. So it's not trying to necessarily replicate the holdings of the S&P 500. It's just trying to deliver returns similar to it. And finally, the final most important thing to consider about this ETF is prior performance. So what I did was I matched this up with a few other dividend ETFs that are popular. I did the ETF SCHD, VYM, and also the Invesco S&P 500 High Dividend Low Volatility ETF to give a metric of performance versus other dividend ETFs. And if you do see, this ETF hasn't been around for that long, so we don't have that much of a history to backtest, but it did hold up pretty well versus other income ETFs like those listed here. And it also did its objective by having less volatility overall. This has the least volatility out of all these ETFs. And it's interesting because even though the Invesco S&P 500 High Dividend Low Volatility ETF is an ETF designed to provide a low volatility, it had the highest volatility here. And JP Morgan Equity Premium Income ETF completely outperformed on that criteria, and it also outperformed this ETF based on total return as well, with those dividends reinvested. JEPI also had the lowest max drawdown too, so this ETF definitely does its objective well. It performs in line, at least historically, from these 3 years with these other ETFs while providing a lower volatility. And it performed better than SCHD over this time frame, which is quite something considering how good of an ETF SCHD is overall. And the only ETF that it did not beat was the Vanguard High Dividend Yield ETF by a little bit. So overall, this ETF performs in line with other popular dividend or income ETFs, and it also accomplishes the objective of being less volatile. So as I said before, I do invest in this ETF. I do put my money where my mouth is. I do think that this ETF is very good. I have a little bit more than $11,000 in this ETF, which is a decent amount of money to me overall. And this ETF is set at a 40% weighting of my income ETF. This does provide generally higher incomes than conventional dividend ETFs strictly. So I am a supporter of this ETF overall. Just wanted to give you some things to consider. If you did appreciate this video, check out the video above for the 3 top things to consider about the ETF SCHD. Remember to like and subscribe for future content, and I will see you all in the next video.